Let's say you have $300,000 you want to put into an annuity. And then you're like, hey, Nick, how much income can I expect to get from this $300,000? Well, my answer is depends. If you're in your early 60s, roughly between $16 and $1,800 per month. If you're in your mid 60s, early 70s, about $1,800 to $2,200 per month. And then the income starts later in retirement, often $2,300 or more per month. Now, keep in mind, those are realistic ballpark ranges, but it may be different from person to person. If you would like to see how much income you could get based on your age, location, and how soon you would like to start generating lifetime retirement income, click the link below this video to schedule a call and we can show you your options. But that brings up an important question. Why does $300,000 annuity pay different amounts? And is there anything you can do to increase how much $300,000 annuity pays you? Well, the truth is that same $300,000 can produce very different monthly income, sometimes thousands of dollars per year apart, depending on how the annuity is structured. And that's what we're going to break down in this video. The first and biggest factor that affects how much a $300,000 annuity pays you each month is when income starts. With an immediate annuity, income starts right away. With a deferred annuity, income starts later, but future payments are often significantly higher. That one decision alone can change income by hundreds of dollars per month, which adds up to thousands per year. The later you turn your income on, the higher the monthly payment tends to be. The second factor is single life versus joint income. A single life usually pays more. A joint life annuity, which continues income for a spouse, usually pays less because the insurance company may need to pay for a longer period of time. The mistake I see is people choosing joint income automatically without ever comparing alternatives. Sometimes combining strategies produces better results than forcing everything into one contract. The third factor is which annuity companies you're actually comparing. Now, this is something people completely overlook. Many retirees assume that annuity is an annuity. So they just go with whatever company their bank, their broker, or the current advisor happens to offer. But different annuity companies can offer very different payouts, even for the same exact $300,000. Some companies pay more income, others may charge more for guarantees. Some offer better flexibility, while others lock you in longer. That's why working with an independent advisor matters. An independent advisor isn't tied to just one insurance company. They can compare options across multiple highly rated annuity providers and show you how the income, guarantees, and trade-offs stack up side by side. In many cases, simply choosing the right carrier can mean there are hundreds more per month, which adds up to thousands of dollars per year over retirement. This is, of course, something we do for our clients. So click the link below if you'd like to compare your options and find the highest paying annuity for your situation. Next are guarantees and riders. Guarantee payout periods, spousal continuation options, and legacy features. These can be valuable, but every added guarantee usually reduces the monthly payment slightly. The goal isn't avoiding guarantees, it's choosing the ones that actually matter for your situation. And finally, interest rates. Interest rates are one of the biggest drivers of annuity payouts. Right now, they matter a lot. And here's why. Insurance companies don't just sit on your money. They invest it primarily in high quality, long term fixed income assets to support the income that they guarantee you. When long term interest rates are higher, insurance companies can afford to offer higher lifetime payouts. When the rates fall, the income they're willing to guarantee generally comes down. That's why annuity payouts today are noticeably stronger than they were several years ago. But here's the part that most people don't understand. Annuity payouts don't move one for one with whatever the Federal Reserve does in the short term. They influence much more about long-term bond yields and how insurers are pricing risk at that time. So even small shifts in rates can change what different carriers are willing to offer, sometimes month to month. That means timing can matter. Locking in income when rates are relatively higher can result in meaningfully more guaranteed income than waiting. But the structure and the carrier you choose still matter more than trying to time the market perfectly. That's another reason why comparing options across multiple annuity providers is so important, because not every company adjusts their payouts the same way or at the same time. Now, if you're concerned about market volatility and want to understand what a $300,000 annuity can realistically do for you, there's a link below. You can watch a short explainer video or schedule a no pressure conversation to review your options. Thank you for watching, and we look forward to speaking with you soon.